Today we're going to go over how to fill out Form 1040 Schedule C. You can get a blank copy of the schedule from the IRS website. The first thing that we need to enter is the name of the proprietor and their social security number. Next, we'll enter the principal business or profession. This is where you'll briefly describe the business, and in today's example, we'll be doing a tax prep business. One thing to note though is if you owned more than one business, you must complete a separate Schedule C for each one. For example, if you had a lawn service as well, you'd have to do a separate Schedule C for each one. They don't get combined. Next, you'll enter the 6-digit activity code from the instructions. These numbers classify the business by the type of activity they are engaged in. This helps facilitate the administration of the Internal Revenue Code by the IRS. You would first select the category that best describes your business activity. Then you would select the actual activity that best describes your principal source of sales. In this example, it would be 541213. Next, you would enter the business name. Next, you would enter the employer identification number. This is the number that was issued to you on your SS4. If you don't have an EIN, you can go ahead and leave it blank. Just make sure you don't enter your social security number here. Next, you would enter the business address. If you conducted business at the same location shown on page 1 of your return, you don't have to fill this out. You can go ahead and leave this blank. Since this is a home-based business, I'm going to go ahead and leave these both blank. Next, we'll move on to the accounting method. If you're watching this video, you're more likely than not going to be using the cash method. You, however, can use the accrual method or any other method that the IRS approves of. The cash method simply means that you record items when they are constructively received or when you actually paid for them during the year. There is one caveat though. If your business has inventory, you generally have to use the accrual method. However, if you're considered a small business taxpayer, you're exempt from this requirement. And the IRS defines a small business taxpayer as one having gross receipts of less than $26 million. Next is material participation. Now this is a big one because this impacts your ability to deduct expenses. If you check the no box, that basically means that your activity is passive and your deductions are going to be limited, i.e. you won't be able to offset other W-2 income. Now don't confuse the IRS definition of passive with trading time for money. This solely relates to whether you actively participated in the business or not. Now, what does material participation actually mean? The IRS has 7 tests to confirm material participation. If you meet one of them, then you're good. You can go ahead and check the box yes. Now, obviously, if business is your sole source of income, you'd likely meet the threshold. This question is geared more towards weekend warriors or those who have a side hustle. I'll cover the first rule, but just be sure to look up the rest of them to make sure you're in compliance. The first rule says, or the first test is, if you participated in the activity for more than 500 hours during the tax year. That equates to about 12 and a half weeks of full-time work, or about 10 hours a week for the year. So you can see material participation doesn't mean that you spent all of your waking hours on the business. It just means you spent a good portion of time on a bona fide business. However, please look up the other 6 rules. Rental of personal property is generally a passive activity, even if you materially participated in the activity. That would be renting things such as furniture, appliances, electronics. There are 5 exemptions listed under rental activities in the instructions on Form 8582. So be sure to see if your personal property qualifies for an exemption to being classified as passive. Line H, is this a new business? Did you start or acquire it in the current tax year? If so, make sure you take advantage of business startup and organizational costs. We'll also cover where to put those a little later on. 1099, did you have subcontractors working on your behalf who you paid more than $600 during the year? If you did, you must provide the subcontractors with 1099s so that they can complete their taxes, and you must file forms with the IRS. Part 1, gross income. Gross income includes income from whatever source derived. The general rule of thumb is to record it unless the IRS specifically says that you don't have to. More than likely, you'll be receiving a 1099 if you're a sole proprietor or in a partnership. Some common ones that you'll encounter are 1099 miscellaneous. This would be for things such as payments of rent, royalties, prizes, and awards. 1099 NEC, non-employee compensation, i.e. you're the subcontractor working on someone's behalf. 1099K. This is a fairly newer 1099, but if you accepted payments or received payments through a third-party network that exceeded a certain threshold, you would get a 1099 from them. Think of like gig employers like Uber, Shipt, etc. Line 1, gross receipts or sales. Here you would just enter the gross receipts or sales from your business. A quick note here is off to the right, there's a box for statutory employees. If you received a W-2 from your employer and box 13 is checked, you need to go ahead and report the income and expenses related to that income on Schedule C. If you had both self-employment income, meaning you had your own business, and statutory employee income, box 13 is checked on your W-2, then you must file two separate Schedule Cs. They do not get combined. Both will end up flowing through to Schedule 1 and your 1040, but they are tracked separately. Line 2, returns and allowances. Here you would report your sales and returns allowances as a positive number. A sales return would be a refund that you gave a customer who returned defective, damaged, or unwanted products, whereas a sales allowance is simply a reduction in the selling price in lieu of cash or credit refund. In this example, we didn't have any. Line 3 would be the calculation of total income. Line 4, cost of goods sold. If you have inventory, you will have cost of goods sold. This is basically your beginning inventory plus your purchases less your ending inventory. Again, if you're a small business taxpayer in the eyes of the IRS, then you're exempt from this requirement of reporting cost of goods sold if you sell products. In our example, we did not have any products. Line 5, gross profit. This is just the total income less your cost of goods sold. Line 6, other income. This could be for things such as scrap sales, bad debts that you recovered. One note, be careful with bad debts because you're most likely a cash basis taxpayer, so you shouldn't have recorded a bad debt on the front end. Now, one other thing that would be included here is the business use percentage of any listed property that dropped below 51%. You would have to recapture that depreciation on this line as excess income. Listed property is property that has both a personal and business use. This would be things such as computer, automobiles, cell phones, etc. So you're allowed to take depreciation on these types of equipment, but if the business use drops to 51% or below, below 51%, then you'd have to recapture that depreciation on this line. In this example, we did not have any. And our total gross income is going to be $100,000. Part 2, expenses. This is where you're going to enter the cost for running your business. Since you only pay federal taxes on the net income, you want to make sure that you capture all of your expenses on running your business. Not recording the expenses correctly is a costly mistake and will obviously end up having you pay more in federal tax, but you'll also be paying 15.3% in self-employment taxes. Most people start out with a simple spreadsheet or a commercially available ERP such as QuickBooks. Both are fine and both have their advantages. But I do recommend going with an ERP because of the reporting and functionality that the system can offer, such as payroll, banking, record retention, just to name a few. So on line 8, we would start with advertising. This could be from Facebook ads, mailers, signs, etc. Next, we would move to line 9, car and truck expenses. You can deduct the actual expense of operating your car, or you can take the standard mileage rate in 2021, which is 56 cents per mile. Mileage rates do vary every year, so just make sure that you have the current rate. Now, you can only use the standard mileage rate if you own the car and you use the standard mileage rate the first year you placed the vehicle in service. This simply means that you started using the vehicle for business, you initially went with the mileage rate instead of actual expenses. The reason behind this caveat is that if you use actual expenses, you likely took Section 179 or bonus depreciation. If you did, then you must use actual expenses thereafter. This makes sense because the standard mileage rate includes a component for depreciation. In our example, we drove 10,000 miles for business at 56 cents per mile. Line 10, commissions. Here you would enter the total of any commissions and fees that you paid for the tax year of your business. Line 11, contract labor. Contract labor includes payments to people who are not your employees, such as subcontractors. Remember those 1099s that we said we were going to issue? They go here. Depletion is fairly uncommon, but if you have it, you would go ahead and enter it here. Line 13, depreciation and Section 179 expense. Depreciation gets complicated very quickly, so it's definitely worth it to have someone assist you with this part. Depreciation is simply the annual deduction allowed to recover the cost of property having a useful life beyond the tax year. It essentially allows you to expense large purchases over time instead of all at once. In our example, we had $2,500 of depreciation. Line 14, employee benefit programs. This would be for things such as accident and health plans, group term life insurance, and dependent care assistance programs for your employees. In our example, we did not have any. Line 15 is where you would enter the premiums paid for your business insurance. Line 16, A and B. This is for mortgage insurance. If you have mortgage on your property and you received a 1098, you would go ahead and enter that amount on 16A. If you did not receive a 1098, you would go ahead and enter that interest on 16B. In our example, we did receive a 1098, so we will go ahead and enter that interest there. Line 17, legal and professional services. This could be for fees charged by your accountants and your attorneys. Line 18, office expenses. This would be for things such as paper, pens, staplers, postage, etc. Pension and profit sharing plans. Here you would enter your deduction for your contributions made for the benefit of your employees to a pension, profit sharing, or annuity plan. This would include SEP and Simple, as described in publication 560. If the plan included yourself as a self-employed person, you would enter those contributions made on your behalf on Schedule 1, Form 1040, line 15. They would not get entered here. And so in our example, we did not have any. Line 20. If you rented or leased vehicles, machinery, or equipment, you would enter the business portion of your rental cost on this line. In our case, we had $1,000. Line 21, repairs and maintenance. Here you would deduct the cost of incidental repairs and maintenance that do not add to the property's value or appreciably prolong its life. Make sure you don't deduct the value of your own labor. You need to make sure you differentiate between a repair and a capital improvement. Think patching a hole in a roof versus a complete roof replacement. Line 22, supplies. In most cases, you can deduct the cost of materials and supplies only to the extent that you consume them. You can also deduct the cost of books, professional instruments, equipment, etc. if you normally use them within a year. If their useful life extends substantially beyond a year, you must generally capitalize them and recover their costs through depreciation. In our example, we did not have any. Taxes and licenses. A few examples would include state and local sales taxes, real estate and personal property taxes on business assets, as well as licenses and regulatory fees paid each year to state or local governments. You would not deduct federal income taxes, estate and gift taxes, or taxes on your home or personal use property. Lines 24A and B, travel and meals. Here you would enter the expenses for your lodging and transportation. You can include flights, hotels, Ubers, and parking that's connected with overnight travel for business while away from your tax home. On 24B, you would enter 50% of your meal expense. Line 25, utilities. If you used your home or business, you do not deduct the base rate of your first phone line into your residence. Now, you can report long distance, and if you had a second line, you can deduct a business percentage of the charges for that line. But in our example, we did not have any. Wages. Here you would enter the wages and salaries that you paid to your employees reduced by any applicable credits. Line 27A, other expenses from line 48 below. We'll come back to this in a little while. Line 28, total expenses. In our case, we would sum all the expenses that we've entered so far, when they come to $45,550. Line 29 is just simply the tentative profit, which is going to be our total income of $100,000 less our expenses. So far for the year, we've made $54,450. Line 30 is where you would enter the expenses for the business use of your home. So this is the holy grail of passing through non-deductible personal expenses to your personal return. To claim the deduction, you would use Form 8829. There are two different forms for reporting this kind of deduction. The first one is the actual method, which allocates expenses from your home to the business use of your home. This is usually the bigger deduction between the two, but it's more complicated and you do have to worry about depreciation recapture and additional record keeping. The second one is the simplified method. This is where you take $5 per square foot up to a max of 300 square feet for a total possible deduction of $1,500. Now, this method is easier to calculate and it doesn't have to worry about depreciation recapture, but it's more often than not going to be smaller than the two of recognizing a portion of the actual expenses. In our example, we went ahead with the simplified method on a 300 square foot office. Line 31, net profit or loss. We would subtract line 30 from line 29. Line 32, at-risk declaration. So in general, the amount for which you can claim a loss is going to be limited to the amount that you have at risk. So if some of your investment is not at risk, then loss limitations apply. In our example, all of our assets are at risk. Cost of goods sold in part 3. In our example, we did not have cost of goods sold, but I'll briefly cover what this entails. So in most cases, if you engage in a trade or business in which the production, purchase, or sale of merchandise was an income producing factor, you must generally take inventories into account, unless you are a small business taxpayer as we defined earlier. Line 33 is just going to be the inventory valuation. Your inventories can be valued at cost, the lower of cost to market, or any other method approved by the IRS. Was there a change in determining quantities, costs, or valuations between opening and closing inventories? If yes, attach an explanation. In our case, we did not. Line 35, beginning inventory. This is just the ending inventory from the prior year. Line 36. This is purchases made throughout the year. You can go ahead and include tax, delivery, etc. Line 37, cost of outside labor. Make sure you don't include your own. Line 38, materials and supplies. Line 39, any other costs. Line 40 is the summations of 35 through 39. Line 41 is the inventory at the end of the year. Line 42 is the calculation of 40 less 41, which equals your cost of goods sold. You would go ahead, if you had inventory, you would go ahead and enter this amount on line 4 back in section 1. Information on your vehicle. You would complete this part only if you're claiming car or truck expenses on line 9 and are not required to file Form 4562 for business. In this example, we are required to fill out Form 4562 because we have depreciation on listed property. So when did we place our vehicle in service? We will say it was October 1st of 2017. Of the total number of miles you drove your business during 2021, you would enter the miles you used for your vehicle. So for business, we said we drove 10,000 miles. In commuting, we had another 1,000 miles. And then for all other mileage, we had 5,000 miles. Was your vehicle available for personal use during business hours? If you have your vehicle at your house, the IRS probably isn't going to believe that you use it 100% for business. So was your vehicle available during off-duty hours? Yes, it was. Do you or your spouse have another vehicle available for personal use? If you only have one vehicle, the IRS isn't going to believe that you have 100% business usage. Do you have evidence to support your deduction? If yes, is it written? With the amount of available apps that track this kind of stuff, it's very easy to do. So you can go ahead and mark yes for both of those. Line 5, other expenses. Here you would enter any other ordinary and necessary expenses not already identified above. One example that I mentioned earlier was the cost for starting up a business on letter H. And the other one that we mentioned was organizational costs. If your business began in the current tax year, you can elect to deduct up to $5,000 of certain startup costs and $5,000 in organizational costs with some limitations. So now that we have a total of $6,500 for other expenses, we will go ahead and enter that number. So in this example, we actually already calculated the $6,500 prior and included that in the total of our total expenses, so we don't need to go ahead and recalculate our total profit or loss. Now that we've covered Schedule C in its entirety, you should have a better understanding of what goes where. So when you're using commercially available software or reviewing your accountant's work, you should know where things go or should show up on your return. Thanks for watching. Be sure to subscribe and give us a like and drop us a comment.